Welcome to Talk Tickers, where we break down the earnings calls that matter. Today we're tackling Kroger's Q3 results, and honestly, it's a bit of a puzzle. They beat earnings, but the stock still took a nosedive. We're going to find out exactly why.
Okay, so this is the big question, right? Kroger beats its adjusted earnings estimates. So why in the world did the stock drop almost 5%? The numbers look decent, management sounded pretty positive, but the market just wasn't buying it. We're going to unpack that disconnect.
All right, so this whole quarter is really a tale of two numbers. You've got the headline beat, and then you have this underlying weakness. To really get what happened, we need to separate those two stories. So check this out. It's a real split decision here. They did beat on adjusted earnings per share, just barely, by 2 cents. But, and this is a big but, they missed on revenue. And maybe even more importantly, they missed on same-store sales. For a grocery, that's a huge metric. And those misses, yeah, that's what really got Wall Street's attention.
And the plot thickens. When you look at the official numbers, the GAAP earnings, well, it's not a profit of $1.05. It's a loss of over $2 a share. Now, this wasn't because they suddenly forgot how to sell groceries. No, this was all driven by one very, very big one-time charge.
And that massive charge is the key to this whole story. It's all about a huge write-down and a major pivot in their strategy. Let's dig into that. Yeah, you're seeing that right. $2.6 billion. That's the impairment charge they took. Basically, it's a write-down on their fancy automated e-commerce fulfillment network. What this really means is they're admitting, hey, that super expensive, high-tech strategy we invested in, it's not working out. So they're taking a massive hit to change course.
So what's the new plan? Well, they're calling it eCommerce 2.0, an asset-light model. First, they're closing 3 of those underperforming automated centers. Next, instead of doing it all themselves, they're going to lean more on partners like Instacart, DoorDash, and Uber Eats. And here's the kicker. They're targeting a $400 million profit improvement from e-commerce, aiming to finally make it profitable by 2026. It's a huge shift.
And this is where we get to the real disconnect, right? The guidance versus the market's reaction. You have management on one side framing all these changes as a big positive, but then you have investors, and they are clearly not convinced.
I mean, listen to the interim CEO, Ron Sargent. He said, "We're happy to deliver another quarter of strong results." So on the earnings call, the tone was all positive, all about strength and executing the strategy. That's the story they were selling.
But when you look at their actual guidance for the full year, you start to see the cracks. Sure, they bumped up the low end of their adjusted EPS guidance. That's good. It shows they're managing costs. But look at identical sales. They trimmed the midpoint. They're basically telling us, hey, sales growth might not be as strong as we thought. And that is what spooked investors.
And this chart, wow. This tells you everything you need to know about how investors felt. Look at the average daily trading volume, about 6 million shares. Now look at earnings day, almost 23 million shares. That's nearly 4 times the normal volume. This wasn't just a few people selling. This was a massive rush for the exits as big money reacted to the news. And the result of all that trading? The stock got crushed, down almost 5% on the day. The market's message was loud and clear. We're more worried about your slowing sales than we are happy about your earnings beat. So where does that leave us? Well, it sets up a perfect bull versus bear debate. There are 2 completely different ways to look at this stock right now. 2 sides of the same coin. Okay, let's break it down. The bull case is all about the future. They'll say, look, this e-commerce pivot is smart. It's going to boost profits by $400 million. Plus, they're cutting costs and buying back stock. That's a solid story for earnings growth. But the bear case, well, it's all about the here and now. They're looking at the sluggish sales, the trimmed guidance, and saying the consumer is getting weaker and competition from Walmart and Target is brutal. They're worried the top-line growth is just gone. All right, so it's prediction time. What's our call for the next quarter and beyond? Here's our official rating and what we think happens next. So for Q4, we're expecting more of the same on the sales front. Pretty sluggish, right in line with that trimmed guidance. The consumer just isn't feeling that strong right now. However, Kroger is great at managing costs. So with that and their buybacks, they'll probably hit their earnings number. What does that mean for the stock? We think it's going to be stuck in a range, basically trading sideways until investors see some real proof that sales are picking back up. So putting it all together, we're initiating coverage with a market perform rating. Look, the e-commerce pivot and the potential for better margins, that's a real positive. But right now, it's just being overshadowed by that weakness in sales. The top-line story has to get better before we can get more bullish. This is not financial advice.